This is In Case You Missed It, your national agriculture news recap for the week ending March 6, 2026. India and Canada will aim to finalize a free trade pact by the end of this year, said Prime Minister Mark Carney on Monday. Carney visited Indian Prime Minister Narendra Modi in New Delhi in a bid to get economic ties back on track. In a joint media appearance with Carney, Modi said the two countries hope to increase bilateral trade to $50 billion by 2030. Trade value was about $9 billion US last year, or about 12.3 billion Canadian dollars. Carney and Modi highlighted expanding opportunities for collaboration in things like agriculture technology and research. They welcomed a proposal for a Canada-India Pulse Protein Center of Excellence in India. The Pulse Protein Center would be a collaboration with the University of Saskatchewan. India is a key market for Canadian pulses like lentils, and 80% of those pulses are grown in Saskatchewan. Saskatchewan Premier Scott Moe said the two countries would work together to accelerate innovation, expand processing capabilities, and to meet demand for quality, sustainably grown foods. China has suspended tariffs on Canadian canola meal and peas until the end of the year and lowered tariffs on canola seed. The federal government confirmed the move on Wednesday. The effective tariff rate on canola seed is 14.9%. That outcome broadly aligns with Prime Minister Mark Carney's expectations. After his visit to Beijing in China, he said he anticipated a total tariff rate of about 15% on canola. In return, Canada has implemented a quota of 49,000 Chinese electric vehicles at a low tariff rate. There's been no indication that China will lower tariffs on Canadian pork or canola oil. The Wheat Growers Association said the reduction is a positive development for prairie farmers. However, it said the disruption highlights the importance of Canada's trading relationship with the US. It also called for accelerated development of the domestic biofuel sector. Hostilities in and around Iran are having an impact on North American fertilizer prices, analysts reported earlier this week. Iran has moved to restrict shipping through the Strait of Hormuz between Iran and Oman. Around a third of globally traded urea passes through that strait. On March 2nd, urea barges in New Orleans were trading 11 to 17% higher compared to February 28, Argus Media reported. Middle Eastern urea producers had suspended offers and were grappling with shipping complications, said Argus analyst Calder Jett. He added that if shipments were delayed or disrupted, that would mean a critical disruption to the American urea supply. StoneX fertilizer analyst Josh Linville said the conflict couldn't come at a worse time for North American farmers who are gearing up for spring. The urea market has struggled to keep up with rising demand due to a lack of Chinese exports and reduced production in the European Union, Linville said. The conflict will disrupt natural gas shipments, which can also lead to higher fertilizer production costs. In case you missed these and other stories from across the Glacier Farm Media Network, visit AgCanada.com or download the AgCanada app.